by Ian Cruickshanks. He's from the South African Institute of Race Relations. He's chief economist there. Thanks very much for joining us, sir.
Always good to be with you. Thank you.
Now, yesterday we saw it was a risk-on day in global markets. They were all doing quite nicely, bubbling away positively. But today they all seem to be in the red. And I was going to put it to you that I suppose that global markets will continue to be on tenterhooks for as long as we see that the biggest economy in the world is sort of uncertain when it comes to policy certainty.
And once again, we've got a political factor which is having a major impact. Uncertainty about the new economic policy stances that President Trump is likely to take. And there's one thing that all financial markets hate more than anything else, that is uncertainty. And this is what we're looking at the moment. So for the time being, volatility will rule, and I think it'll be hard for the market to attain new highs under those circumstances.
Now, when we look at the second largest economy in the globe, China, we see that the MSCI benchmark for emerging markets, it incorporated a further over 200 Chinese companies were put on that benchmark. Now, that means that an international investor can go there and invest. We saw the number come out for Q2 that the Chinese economy grew by 6.9% year on year. That's very positive. And they're actually sort of poo-pooing the idea put by some that they're going to experience a hard landing. They continue to grow. So with South Africa experiencing poor growth at the moment and people wanting to look for better places to invest, do you think a South African pension fund manager or fund manager in general should be considering investing in those type of benchmark indexes?
Certainly considering it. After all, just looking at the state of our own economy, which is not reflected in share prices right now, but will be over the next year or so, we're in recession. The chances are we could stay in recession for most of this year. If that is so, fund managers have got to look for a hedge against this potential downside. Where do they get it? In potential growth economy. Certainly the Chinese economy, according to the statistics which have been released, looks as though it's a go for growth type area right now. So really, I think that one can find sound companies, strong capital base, which do have a strong outlook, a positive outlook, and I think there should be some exposure. Not an overexposure, all in, but just to say, as part of geographic distribution of one's assets, this is a must-go.
Now, you've said something quite jaw-dropping, this whole issue about recession for most of the year. Now, if somebody comes out and responds to you and says you're just busy scaremongering, what is behind your assessment?
Well, I don't think so. Just look at the statistics which have come out. We've been talking about the possibility of recession since a year ago, and what we're saying, look at consumer confidence. Consumers are not buying the same amounts of goods as they were 2 years before that. Just look at the results from the retailers. Look at the shopping malls. Many of the bigger, newer malls have got a 10% vacancy rate. Why? Because businesses, small to medium-sized businesses, have closed. Consumer confidence is at a low level, hence business confidence is at a low level, and there's no new fixed capital investment. Those people who were thinking about it, many of them, have been scared off by political developments here, and uncertainty of the safety of their assets, uncertainty of the security of a constant and reliable electricity supply, uncertainty about labor, who don't seem to understand there's got to be a straight line between productivity and reward. Until all these features are absolutely certain, we're going to find that the economy is in danger of slipping backwards.
All right, fair enough. You've painted a fair picture for that assessment. And looking at the UK, they're in the middle of their Brexit negotiations with the EU. They're having a straight 4-day session, Monday right through to Thursday. They're hoping that they're going to have some sort of blueprint from which to work from in terms of negotiations going forward. But they really don't have much time, and there's so many complexities, aren't there? I mean, do you think this thing is actually going to fly?
Eventually, it must. Those decisions have been taken. But I think it's going to be an inch at a time. And it's going to be very much each side struggling for economic advantages. And they're going to be it'll be very difficult to see them giving in to their own economic disadvantage. So I think it'll be very slow progress. And in the meantime, of course, that slows down the potential for business development there. So I think the EU is in a go slow area economically for the medium term anyway.
And then back home, we have significant data out tomorrow, CPI, consumer price inflation, and retail sales, which will give us a picture of what's happening with the consumer. Don't you think the Reserve Bank should give us a break and give us an interest rate cut?
Well, no. For the sake of consumers, yes. For the sake of the country and capital flows, I have to say no. You know, we're finding that the JSE is losing a great deal of foreign sales. Foreigners are saying, no, we're not trusting the outlook for South Africa, for its economy, therefore for our companies and the stock exchange, and they've been taking away their investments here, putting them into cash and taking them elsewhere. We're even seeing that in the bond market. So,
but let me interject.
Yes.
Why are we seeing the rand strengthening right now?
That's difficult to accept, but I think it's not just the rand strengthening. We're measuring it against the dollar, which is going through a globally a down phase. It's globally weak. Temporarily only, I'd say. But if you look at the dollar index, that's the dollar measured against a basket of currencies of their major trading partners, the dollar has come back a bit, and therefore other currencies measured against that look a bit better. Not necessarily their own internal strength, but against the measurement.
No, fair enough, understood. And very lastly and quickly, what are your thoughts about the platinum sector? It's not looking very good.
No.
Lonmin has made massive cuts right down to the bone, and it managed to increase its productivity, but it doesn't seem as though there's any demand for platinum. And the prices are not really coming up.
At around about $900 an ounce, it's difficult for Lonmin to get more than break even. And their trouble specifically is now, then there's nothing left over for new capital investment. The capex looks like it's not going to happen. Therefore, they can't grow the business. They can't move into new areas. And of course, that has a profound effect rippling through to the whole area in which they're operating. So also with the likelihood of electric cars, look at the developments in America, where in the next 5 years, they're expecting more cars to be powered by electrical engines than the internal combustion engines, which we know so well now, going on petrol and diesel. So I think really the need for platinum for the autocatalyst is less than it was. That's not a positive outlook for Lonmin. We've done an analysis on it, and we think that it's at least 20% overvalued at the moment on a 12-month view.
Well, it sounds like a threat to both platinum and oil, doesn't it?
Regrettably, yes.
We're going to leave it there. Thank you so much, Ian. Well, that was Ian Cruickshanks. He's the Chief Economist at the South African Institute of Race Relations. After a